Welcome to This Week in Money. I'm Jim Goddard. Today, market historian Bob Hoye from chartsandmarkets.com runs down the action on the major markets over the past week. He tells us that bonds have been looking up. Discovery Watch's John Kaiser digs deep into the junior miners and what's been affecting investment in the mining sector. Founder of EdSteerGoldandSilver.com, Ed Steer, takes a close look at the gold and silver markets and what he believes has been their manipulation. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Bob Hoye right after this.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYresources.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Bob Hoye, market historian and chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Hello, Jim. Good to be with you.
Bob, did the equity markets hit new highs the past week?
Yeah, if you take a look at the Standard & Poor's 500, yep, there was a new high, and Dow Jones, yeah, it didn't make a new high. And also the one that we look at is NYA. That's the New York Stock Exchange Composite. Now, it was up on the week, but not making a new high. That one actually, the broad market in New York made its big high in January of 2018. So, and then you can see big swings on it since. So, yeah, the Standard & Poor's made a new high. What is going on here, Jim, is that the institutions around the world are buying the New York market. It's the most liquid stock market. And also, you're in U.S. dollar terms, which currency has been quite steady through the year so far. So they figure it's a good place to be. So, but they're buying the S&P type of stocks, the big companies with the big liquidity, and the rest of them are not making new highs. So there's let's call it a division in the market there, where investment-grade stocks like the S&P are making new highs, and the broad market, as represented by the New York Stock Exchange Composite, is not. The other one is like you take a market for world stock exchanges, and all I know is the symbol on it, WCI. It made its big high with terrific momentum in January 2018 and is churning around at less than that high. So it's quite a while for no net advance, taking out the swings. Also on the week, it's been good for bonds. You had in long Canada's long U.S. Treasuries up in price, down in yield a little. You had investment high-grade bonds up in price, and you even had junk bonds and high-yield bonds up in price. So the interest rate market was friendly to investors today. One of the things that's going on in interest rates that isn't widely covered is the Treasury bill rate, and the U.S. 3-month Treasury bill has been declining in yield since it made its high in March, April. And this is an important one, Jim, that we've found that throughout commercial history, like going back a few hundred years, that when you're on a boom, short-dated interest rates such as the T-bill goes up in yield, and then in that it's been going down in yield for a few months now, and it was down quite sharply in yield that says, well, I'll back up a step on that one. If interest rates go up in the boom and they go down, what's it beginning to tell you? So it's beginning to say that, hey, maybe the boom is declining. There's some of the reasons for driving short rates up would be by speculators playing in the different games. There's always leverage, so there's a demand for short-term money there. And then when the speculation starts to ease, there's less demand, so that rate would go down. And then the other side of that equation is very careful money around the world that needs to park somewhere, and it usually goes to most liquid items where it can get in and out, and that, of course, shorter than 1 year Treasury bills in the U.S. is a very liquid part of that kind of the market on the credit side. And then, of course, the other one is that gold provides a certain kind of liquidity as well. And gold's been acting well since last fall, and gold stocks have been good. Yeah, they have been good, but the gold stocks are kind of getting a little overbought in here. And what we're looking at, Jim, is that it's been a fabulous bull market ever since you had the disastrous plunge end in March 2009. It's been a long bull market, and it a couple of years ago was very, very strong. So you're now up with the general stock market, and there's different ways of valuing it. One we like is take it relative to gross domestic product, GDP, or the S&P relative to average wages. And it's been very high. At its highs, it's been higher, much higher than 2007, and you know what happened after that. And even higher than with the crazy dot-com bubble in 2000. So by a couple of standard measures, the stock market is very overpriced. And then on some of these speculative rushes, it's had very good momentum. And the sentiment numbers, you know how many people are bullish, that sort of thing. So it's been very good, but it's also showing between the valuation and momentum rushes signs that you really only see at important highs in the stock market. So our work suggests that we're very close to an important top in here. By important, I mean cyclical. And there's a few things that we'd be watching to kind of give the signal on that, and that being the credit markets with the yield curve and credit spreads, which we monitor closely all the time. So we have had a very good party. We've got ways of measuring the party, and we also have ways of determining when the party's likely to end. And so it's time for most investors to begin to be cautious, begin to build some liquidity, and contemplate that oftentimes if you've had a great booming market, the chances are that the first big correction on it would come in the fall. And again, we're monitoring the yield curve and credit spreads for this opportunity.
Bob, thank you so much for being on This Week in Money.
It has been a good week in the markets, and we look forward to watching what happens next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He was speaking to us from Vancouver. Coming up, John Kaiser, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
This Week in Money is archived online at talkdigitalnetwork.com.
We're speaking with John Kaiser, his website, kaiserresearch.com. He does a regular show on House Street called Discovery Watch. Welcome to This Week in Money, John.
Jim, it's a pleasure to be on This Week in Money.
John, for people new to perhaps what you do and what your company's all about, what can you tell us about Kaiser Research?
Kaiser Research is an online information platform that covers all the resource companies, mining and exploration, listed on the TSX, TSX Venture, CSE, and the Australian Stock Exchange, in addition to being this fantastic research tool with a search engine that's unparalleled anywhere. I also try to highlight those companies which I think are particularly good speculative value for people who either want to bet on metal price going higher or on a discovery coming from some project that a junior has, which the market's valuing at next to nothing, but has very good upside if they deliver what they're going after.
John, are we getting a summer rally in the mining juniors?
Hopefully, it's not a summer rally, because a summer rally is something that comes to an end. Normally, summer is when the juniors get their exploration programs underway. Promoters will call up investors and say, we're doing this and that, and we think we're going to have a winner. There's an anticipation cycle. The stocks go up, people buy it. And then come September, October, we start getting the exploration results, and sometimes they're really good, and the stock keeps going right through into the next year. Most of the time, however, the results disappoint or are merely encouraging, and the stock price fades, which is why we call this the summer rally. But we're in the 8th year of a bear market, and we don't have these types of rallies anymore. We didn't even have a January effect rally in the first quarter of this year. Everybody is so demoralized and negative about this junior resource sector that they view all exploration plays as a failure until proven otherwise. The glass is worse than half full. What I think we are seeing here is the beginning of a sustained bull market. We are in a very subtle turning point, and we are seeing the value traded on the venture exchange start to go up. It is pretty well diversified. A month or so ago, we saw Atlantic Gold jump up with a big takeover bid, and that made it look good. But now we're seeing money starting to come back in, and it's kind of like you've got a kettle full of corn, and the corn's been like all turning black and just burning up for the last 8 years. But in normal turnarounds, you start seeing an individual kernel pop, and you wonder, what was that? That looks interesting. Wow, fluffy piece of popcorn. Geez, I haven't seen that in a long time. Then you start seeing another one. And then eventually the whole pan goes crazy, and in the end, there's only a few blackened duds in the bottom. We are now in a 6-month beginning of the pan of corn kernels to start to pop. It is not a summer rally. It is the beginning of a sustained junior resource sector rally, and it's going to be driven by gold.
How long can gold and silver rallies last?
If you take a gold chart back to 1972, which is when they released gold from its gold standard prison and allowed it to trade freely, there were 2 roughly 10-year cycles. The first ran from 1972 to 1980, and gold got as high as $850 before settling back to around $400. And then it spent 2 decades going sideways, bumping between $260 and $500. The second rally started in 2002 and climaxed in late 2011, hit 1950, and since then we've had 8 years now of gold sort of around the $1,200 mark, bumbling up and down $150. And now we are at the beginning of another breakout. And I think this one, we're not going to have to wait another decade, such as we did in the 80s and 90s, for gold to take off. When that happened in 1980, the gold, inflation adjusted from $35 to 1980, that was $77. Yet gold stabilized at $400. That works out to a 400% real gain in the price of gold. And that made a lot of ounces in the ground low-hanging fruit for the mining and exploration industry. And since then, we have almost doubled the above-ground gold stock to about 7 billion ounces. But the last rally, which stabilized around $1,200, if you inflation adjust $400 gold from 1980 to present, you get $1,251. Well, that didn't really create any low-hanging fruit. Nominally, it looks great. Yeah, what are you whining about? Gold's up 6 times from what it was, in 2001. But the real price gain is only 12% even today at $1,400. So this time around, see gold develop an uptrend that is similar to what we saw in the late 70s, where it was a very substantial real price increase. This last 10-year rally that we had that started in 2002, that was a delayed inflation catch-up. This time around, we're dealing with a different dynamic. It's not about gold tracking inflation. It's about gold tracking uncertainty about what directions the world is taking.
When you invest in junior miners, what are your thoughts on the jockey versus the horse, and maybe explain what that means?
Well, the jockey is regarded as the management. Is this a Ross Beatty or a Robert Friedland, people with a proven track record? And the idea is that don't put your money on a nobody that you've never heard of. Put your money on somebody that has this track record that will deliver success. But I personally think it is a waste of time to bet on the jockey, because once a group has become a jockey, they tend to do all their initial positioning with other economic elites, and the general public is not invited to the party until the stock is substantially higher, and they, it does a reverse takeover or something. All of a sudden, everybody, the elites loaded up at 10 cents in the jockey's company, and then it comes out at $1, $2, and that's when we are invited to bet on the jockey. That's BS. I prefer to bet on the horse, and I even like it when the jockey doesn't have the greatest reputation in terms of success. You do have to be careful about a jockey who has a history of stuff borderline criminality. You definitely do not want to bet on that type of jockey in terms of it being like not a proven winner. But when they are not as fully competent as the big success stories, then you get good value for the horse. And the horse is the project, the story that they are trying to advance. And here's an example. Robert Friedland has had several absolutely off-the-scale successes. Voisey's Bay in Labrador, the nickel-copper discovery, $4 billion buyout. Oyu Tolgoi in Mongolia, and more recent Kamoa-Kakula in Congo. All of these are like super world-class discoveries that his companies have made. But don't ask the people who bet on the jockey behind Kaizen Discoveries and Cordoba. Those people that had the same jockey, Robert Friedland, but these stocks are absolute disasters. So I would say look at the horse first, and then look at the jockey.
We'll have more with John Kaiser when This Week in Money returns.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with John Kaiser. John, what's on the move besides gold and silver juniors?
Well, in the past few years, it has been the battery metals, lithium, cobalt, vanadium, lithium, cobalt, and even graphite are related to the whole electric vehicle mania, whereas vanadium's more linked to a long-term storage from all renewable sources of energy, such as solar and wind power. And all of them had big price runs, but all of them have pulled back sharply from those levels. And the juniors that piled into them, you have like ABC Cobalt Corp, ABC Cobalt Limited, all these companies, they have all failed and are going away. Vanadium is the more recent one. Those ones are still in the game because vanadium has pulled back somewhat, not as far back as from where it started with, whereas cobalt's right back where it started. So these battery metal plays, they're no longer on the move. The group that is on the move are the platinum group metals, in particular palladium, which is now trading almost double the price of platinum when it used to be the reverse. The reason for the palladium rally is twofold. One, Volkswagen screwed up with cheating on its emission tests for its diesel cars, and there has been a backlash, people moving away from diesel cars, and the diesel cars, catalytics, converters, they use platinum, whereas gasoline cars, they use palladium in the catalytic converter. So you have had a demand fall off for platinum and plus a demand surge for palladium as a result of this diesel cheating scandal. The other reason is that much of the world's palladium comes from the Norilsk nickel mine in Russia, and they are doing a major renovation and expansion which has reduced the supply of palladium from that operation. And that, of course, has resulted in the price of palladium going up. And the last estimates I have heard that this will not be finished until 2022 to 2025. So we have a period where there's not going to be any extra palladium coming from anywhere, and there's no reason to believe that people are going to swarm back into diesel cars. So we will have a period of elevated palladium prices, and this is interesting for the juniors because the ratio of palladium to platinum tends to be half in South African deposits, but almost everywhere else in the world, the ratio is 2-1. And of course, South Africa is the big platinum powerhouse of the world. But platinum itself may still get its day. All the hype is on electric vehicles powered by lithium batteries, which you plug in. But hydrogen fuel cells have always been in the background, and hydrogen fuel is one way of converting all that renewable solar and power energy into stored energy. Its problem is the distribution networks. Where do you fill up with hydrogen? And platinum is the magic ingredient inside the hydrogen fuel cells, not palladium. So I think that will be a trend that I think will start to attract more and more juniors, reviving these deposits that were acquired by groups like Stillwater and others in the past decade. I'm seeing them go back into the juniors. Rare earth is another potential trend. We had rare earth mania 1.0 back in 2010 to 2011. It was way overdone. The rare earth prices today are a fraction of what they were back then. But because most of the world's rare earths still come from China, and we have escalating trade war and even broader geopolitical tensions between the United States and China, it is conceivable that we will again see a shortage of rare earths, and not necessarily because China suddenly holds back supply, but also because China is on its own environmental mitigation campaign. China cheap rare earth prices are due to the fact that they have not cared about the mess made downstream from processing rare earths. It's also been wasteful production, so a very valuable strategic resource is being depleted faster simply through sloppy enforcement of the rules. So as China cracks down on these polluting and often illegal operations, we could see a shortage of rare earth supply relative demand, especially if the electric vehicle trend continues to grow, because these neomagnets they are still part of the electric vehicle future. So that's one area which could be trending. Zinc is the one where I've been watching for some time. The assumption is China is going to continue to supply zinc. It's 40% of global supply. It came from nowhere in 1980 to dominating everybody. But nobody knows of a single large Chinese zinc deposit. It comes from hundreds and hundreds of small-scale deposits, which must be reaching the depletion limits, which are also polluting and get caught up in the same crackdown on polluting operations. So the assumption that Chinese supply will at the very worst be stable, that could be a flawed assumption also, and we could actually see Chinese supply go down. But what's hurting the market there now is the perception that the whole global economy is heading for a downturn, and we're seeing it in the slowdown in China. And of course, people are extrapolating the consequences of protectionism and the disruption of supply chains as also causing a global downturn. So these base metals are not very popular at the moment in terms of being seen as having positive price trends that are going to be good for the juniors.
Younger generations have not experienced runaway markets in gold and silver, although they have experienced pot stocks and cryptocurrencies. Once the younger people become aware of bull markets in gold and silver, are they likely to jump on board?
I find it very difficult to visualize a runaway gold market. Now, that was always the story back in the late 70s and early 80s, where gold was going to go to 2,000 and higher, and a lot of the gold bugs have predicted, $3,000, $5,000, $10,000 for gold, and they've usually linked it to stories like fiat currency debasement and hyperinflation and things like that. But these aren't really happening in the U.S. economy. Inflation is still muted, and even if the price of gold goes up as an inflation adjustment, it doesn't really help the juniors, except perhaps in the beginning when you don't realize that the cost of producing gold is now way up and that the nominal gain is absolutely meaningless. I go back to the earlier example. The inflation-adjusted price of $400 gold is $1,251, and so we've got gold now at $1,400. It's not up in a big way. There hasn't been much gained, even though gold going from $260 to $1,900, that looks like runaway gold. Now, it's stabilized at these levels, and for a younger generation to perceive a runaway gold price, that's seeing it go to $3,000. But if you understand the math of the cost of production and imagine that is relatively stable, but pure demand linked to uncertainty about the world, where it's going, driving up the gold price to, say, $3,000, that has huge implications for the bottom line, for the profitability of mining ounces in the ground. That's what these gold optionality plays are all about. And so a deposit, your 2 million ounces that are worth nothing at $1,400 gold, at $2,000 gold, they can be worth an awful lot. And you have some 20-cent company out there could go to $2, maybe even $20, based on that going from being worth nothing to being worth an awful lot. And it's those optics which the market is going to want to see. They are not going to get very excited about seeing gold go to $2,000 or anything like that. They will have to see the juniors going up 10 times in price because gold has gone up 35%. So no, I don't think the younger generation is going to come into this sector because of runaway gold prices. And if gold prices do run away, this older generation that I'm part of, we will have made a hell of a lot of money before the younger generation even realizes that this has happened.
For people new to investing or speculating in the junior mining markets, how do the junior mining markets work?
Junior mining markets are very inaccessible for novice investors. One could even say they don't work at all. And that is because you have to understand something about geology. You have to understand the economics of mining. You need to be familiar with something called a discounted cash flow model and terms like after-tax net present value and internal rate of return. These are concepts that not even a lot of the promoters of these resource juniors understand. And even though they're supposed to be doing what's called economic geology, when they look at a prospect and they're supposed to think to themselves, well, what could this target end up being? A 2 million ounce vein? And if it exists, what would it be worth? What sort of mine would be there? This act of the imagination, what we call back of the napkin calculation, this is what economic geology is. And if you can see a prize with significant size emerging from this target, well, then you should go ahead and raise money and try to explore it. But you're not allowed to actually show the public. There are rules against quantifying the size of the prize. So if a new investor comes along, the promoter can be sitting there absolutely jumping up and down with excitement about this fantastic target, but all they can do is point to a bunch of dots on their map and expect the poor investor to connect them and turn that into a $2, $5, $10 price target, which would be the reward if they actually win. So, no, the junior mining markets as they are set up right now are virtually inaccessible to new investors. And that is a huge problem facing this sector because we have had the older generation that still understands this stuff and has sort of an intuitive grasp of how it works, that is becoming a smaller group. And the younger generation, they've chased into those crypto and pot type stories where it's all just about momentum, where you really don't need to know anything except that the trend is your friend until it is not.
Do stockbrokers still play a big role in the junior mining markets?
Unfortunately, they do not. And the brokers themselves can't be to blame. First, there was the deregulation of commissions, which started in the 90s. In the good old days, any trade you did, you got 3% commission, which was split between the broker and the firm that the broker worked for. And so churning the account, doing as many trades as possible, that was how you were a successful broker. And so that meant calling up your client and giving them many ideas. And as part of that, the brokers served as information hubs. Back then, the only information about junior mining companies was in paper form. You would get your Stockwatch or George Cross newsletter delivered to you in the morning, hand-delivered, and of course it's all the downtown area, so everybody would be reading this and be up to speed on the latest news, and then they would call the clients and say, this has happened, and this is going to happen. And then the brokers would also contact the promoters and each other and go to the bar after 1 o'clock and pick up rumors and other stories, which they would also feed on to their clients. But along came the internet, and all of a sudden, all this information was there, available for the public to look up, and they had the discount brokers where commissions became very, very small. So the clients, in a sense, abandoned the brokers, and the brokers have now shifted more to fee-based asset management where you don't want to talk to the client. You just want to get the client's money in the door, and then you put it into all these structured products, mutual funds, all these passive instruments, following some sort of algorithm that your brokerage firm has come up with and applied to the profile of the client. Eventually, this broker will even be gotten rid of and replaced by a robo-broker, where it is a robot that actually manages your account, rebalancing it every day, and you have some research department in the background classifying the different instruments that the firm is happy to feed you.
Has overregulation made it tough for participants to play in the junior mining market?
I hear this a lot, and the proper question to ask is, okay, where is the overregulation happening? Now, after BRIEX, we had the 43101 reporting system be developed, which required an extraordinary amount of detail to be assembled by independent qualified professionals that had to sign off on it. The rules are made very clear about what the company could or couldn't say. It really raised the cost of being an exploration junior. And the complaint to some degree is, okay, we got all this information here, but the public's not really doing anything about it. And I think there is a solution to that problem. I call it the Share Collective. It's one of teaching the public to do what the company executives are not allowed to do. It's to connect the dots. The regulators enforce the reliability and accuracy and abundance of dots. This is it's screaming for a solution in terms of some external system out there. Something like Kaiser Research online does it, but it only does it to a limited degree, because I myself can only cover, a couple dozen companies out of the several thousand that are available out there. The overregulation, which I am upset about, and which I think is very harmful to the resource juniors, is that of restricting the ways that money can go directly into the corporate treasury. Because these juniors, unless they maybe farm the project out to a major, they can't create new wealth without raising risk capital to fund exploration programs and deliver a new deposit. And yet the brokers are not playing any important role in financing this anymore. The juniors are seen as way too high risk. The older crowd that is interested in perhaps investing in these juniors, the 55 and older crowd, the regulators have created this suitability rule where if you put somebody like me who's over 55, put me in some little exploration junior and it goes down, the brokerage firm has a potential liability that, say, if I have a heart attack and I'm gone, my kids might look at all these accounts and say, oh, how come you let daddy invest in all these high-risk things and lose all this money? We're going to sue you for putting him into these unsuitable things. And so the banking establishment has said, we're not even going to let these people invest in these juniors. So, and then they have the accredited investment rule, where you have to be worth $1 million outside of the equity in your primary residence. And how many people actually qualify as that? And of course, so people lie on their forms and say, yes, I am an accredited investor. So the regulators are now creating paperwork where I'm supposed to put down detailed financial information, not just about myself, where my bank account is, whom I work for, how much money I make, but also for my spouse. And of course, everybody who has half a brain says, over my dead body, am I putting this information on a piece of paper and then sending it to some little junior company where who knows who the hell handles it, and all of a sudden these people have all this information about me? I mean, it's almost evil that the regulators are asking for this. Now, they did do one thing that I thought was a very good step. They invented something called the existing shareholder exemption, where people who are not these millionaires can buy up to $15,000 in one company, per company, per 12-month period without, being an accredited investor. But they made this complicated by insisting that when the financing is announced that's available for this exemption, the individual already needs to own a share. Why is that necessary? All of a sudden, the company has to verify that I own the shares, because of course I'm going to lie and say, yeah, I own shares in this company, and what are the consequences if I lie? Well, there really aren't any consequences, and yet there are consequences for the company if it is true. So they have created this obstacle. It's almost a deliberate obstacle so that they can pretend to be helping the companies by allowing a much broader range of the audience to put money directly into the treasury through private placements rather than just buying in the open market. They've created this verification obstacle. They need to relax in this area. They need to let the clients who the brokers can't afford to do anything with, let them be at their discount brokers, be able to contact the company directly and do their up to $15,000 worth of a private placement if they like the story. And of course, the company should do this on a first-come, first-served basis. And the regulators should get rid of this ridiculous, 50-page documents of legal mumbo-jumbo that you're supposed to print out and initial, and like every fifth page actually has something where you put in some information. They need to streamline and simplify that so that ordinary people, all they need to do is make the decision, I'm going to give $10,000 to this company to help them do that $1 million program. This needs to be all simplified. This over-regulation in this area, that is where I see a big problem hurting the junior resource sector.
Are most participants that play junior mining stocks, pot stocks, and cryptos considered to be educated investors?
They are not really educated. And with pot and crypto, what is there to know? I mean that in the case of pot, it's cannabis. It's a winner-take-all story. Who knows what management is going to do to win the battle against all the other companies to inherit the entire cannabis supply space. And in the case of crypto, well, it's a greater fool spiral. How long will the greater fool spiral last? There's no intelligence which will give you an answer for that. But again, with the resource juniors, you do need to be far more educated than for these other sectors, and most people do not have sufficient understanding about how the resource game, the fundamentals work. And in the resource game, you're betting on fundamental outcomes, venture capital outcomes, high-risk outcomes. Will there be a deposit there at the end of the exploration season? And if you cannot understand how to even quantify that potential prize and what is needed to even signal that it's been achieved, well, you're not going to be able to make any money in this sector because you're going to just be making random bets.
We'll have more with John Kaiser when This Week in Money returns.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with John Kaiser. John, when it comes to investing in the junior mining market, how can people educate themselves?
Well, Kaiser Research online, I make a point, and people complain, say, win back Kaiser. I make a point of explaining the entire sort of geological context, the rationale, the history, what is the hook. And so by subscribing to something like Kaiser Research online, where I actually present an argument as to why you could make a whole bunch of money, that is a form of educating yourself, as opposed to some newsletter writers who put some boilerplate in there about the company's wonderful, the project's wonderful, I think it's going to go up. You don't learn a thing other than and that this guy is endorsing this company for who knows what reason. It is a problem to get educated about the resource juniors because not many people want to pay $450 US a year for access to all my material. And that's why the Share Collective that I'm a founder of, I see that as a future education engine, not just for re-educating the older generation, which may be a little rusty in doing back of the napkin calculations, but also bringing in a new generation of millennials who are familiar with online stuff. If they go to a site where they can find the project and then they see a form. It's put it a deposit and some grades, and then sort of what sort of mine would this be, what would the costs be, and fill in all these figures and push a button, and it presto generates after-tax NPV. And if they like it, they can share it to the project for everybody else to see, and everybody can look at it and to do their own version. And to be able to do that, you have to very quickly start understanding something about geology, and you also what is a mining model? How do the economics of a mine work? And if this can be done in a way where you end up making money because you understand that, people will very quickly figure out how this works. And then they'll start wandering down the curve, go into the Geology 101 and try and figure out the difference between a vein and a porphyry system, and different mining types and so on. So creating an online portal where the crowd can actually participate in a way that they can see themselves participating and see everybody else see them doing it, that becomes the new sort of education vehicle for bringing new audiences back into the junior resource space, not a bunch of victims that you're going to put the noose around their neck and hang them, but people who are going to fast track, learn how does this space work, and become very effective gamblers, and they become, through this process, they become allocators, efficient allocators of capital to the projects that have the best potential. Because part of the problem of investors being ignorant about how exploration and mining works is that lifestyle companies who have stories that have no chance of delivering a prize of any size, they are almost indistinguishable from the others as far as these uneducated investors are concerned, which is why you have this line, bet on the jockeys rather than the horse, because the jockey, you can see the reputation, but you lack the ability to distinguish a worn-out old nag from a hot new racehorse. That sort of psychology needs to be changed, and it's not yet really out there, but it is coming. Stay tuned.
If someone purchases 10 junior mining stocks, what will their likely outcome be of winners and losers?
That really depends on what the makeup is of those 10 stocks. Now, if you've got 10 optionality gold play stocks in there, and gold does what it's done in the last 8 years, well, then you'll have a portfolio that at best has done nothing or shrunk in value. On the other hand, if gold rockets to $1,800 overnight, all these things will be up 5-10-fold, and you'll make a huge amount of money. In the resource junior game, the trick is to diversify your portfolio amongst different metals, different stages of projects, different jurisdictions. Do not all put them into like the golden triangle stocks or all into copper stocks or vanadium because you think vanadium's the next hot thing. Have a mixture. And you diversify some of that risk of leaving money on the table because you're in the wrong sector. You do miss out on being gloriously right, but you could be that just putting all your money into one optionality gold play and doing it that way. By diversifying, you expose yourself to these different things happening at different times for different reasons. But more importantly, investing in these resource juniors, it's not just about trying to make more money than owning some index fund that just tracks whatever it is the market does. It is a form of gambling, and gambling by its nature is not really a business. It is a form of entertainment. And if you can make your entertainment not be something that costs you money, but also makes you money, then you've got a good thing going. And the resource juniors, they have the potential to provide a lot of entertainment. So having diversity in your 10 stocks, something's going to be going on with one of them at any time. And all you really need is one of those stocks to be exciting you and entertaining you. And when that ends, another one will have picked up. As for predicting what will the portfolio be up at the end of the year, that is impossible to predict. But the purpose of being in the resource junior sector is that in the longer run, you want to definitely outperform the market index by a factor of 2, 3, 5 times.
How important is it to hang on to winning stocks and sell losers?
You know, it really depends on what your expectations for owning that position in the first place is. When I buy a stock, I do it for a reason. Like, here's this drill target, here's what they think they're going to do. I have a timeline for it. Sometimes it's just a one-season timeline. And if at the end of the season they haven't delivered, and they've even killed the project and they don't have a replacement, then I just say, okay, it's over. And on the other hand, if it's one of these ones that keep going, you ask yourself at each point, okay, if I had never heard of this stock until today, and I looked at all the fundamentals, would I be buying it today? And and if I didn't have any money to buy it for myself, would I tell a relative or a friend to buy it? And if you can't bring yourself to do that, then you need to say goodbye to that stock. So you got to have expectations whose fulfillment or non-fulfillment you are able to monitor. And then when you've done that, you have to be pretty hard-nosed about whether or not you stick with it or move on.
Should potential investors, speculators research and call a junior mining company before they buy the company's stock?
Well, if that was the requirement, nobody would ever buy anything because the phone would be busy nonstop. These juniors, they're lucky if they have 5 people working for them, and they're lucky if they have one IR person devoted to answer the phone and explain stuff. In the old days, you would call your broker and the broker would explain stuff, and maybe you would call the company and listen to some nonsense over the phone. But in the internet age, all of this has changed. Before you talk to any company, you go to their website and you click on the corporate presentation. If it's 2 years old, move on. If it's relatively recent, go through it. They usually organize these presentations to present the story. They have the sort of factual stuff like who the people are and the structure and how much money they have and all this sort of stuff. But usually it's presented in the order of most important project to the least important project on which money is going to be spent. And then you walk through this and see the way they present it, with analogs, cartoons showing, well, this is a low sulfidation epithermal deposit, and we think we're in that part of it, and all this stuff. If that makes sense to you, well, that's a good thing. And then the next step, before you try to call the person, you go to YouTube or even the company's website and see if there's a conference where they have done a presentation that's been taped, and you watch who is doing the presentation. Is it some IR underling, or is it the chief executive officer? How does that person come across? Is there some degree of passion, or is this person just sort of walking through this chore for which they're being paid way too much money to be? Get a sense of what is the management like? And only after you've done that and you still have questions, that's when you call the company. Never call a company, say, and ask them, why is your stock going to go up? you need to ask specific questions. What about this and this and that? You need to do a lot of the homework yourself. Only then, if you still feel it necessary, should you call up management and start picking their brains. And then, if you get the IR person will immediately detect, this person has done their homework, and usually the higher-ups are not available, but they'll take your number, and that higher-up will get back to you with answers for the questions, for the intelligent questions that you have come up with.
If the people running a junior mining company are known for rolling back the stock, is that a red flag?
It is definitely a red flag. And the traditional model in the junior exploration game is for these lifestyle companies to start off with some shell that's already been rolled back, create a whole bunch of cheap paper for themselves. Because there's a small public float, they're able to manipulate the price up. Along the way, they rent a story from, farmed into from some prospect generator. And when they've got it high enough, they pay some mass marketing, social media, this or that, to bring in buyers. And then they sell their paper to these outsiders who think they're buying a real story. And maybe there is a token exploration program that has been done on the project, which even if it delivers something, the management doesn't have the technical skills to realize that they're actually have a discovery on their hands. They've blown their paper. They walk away. The price collapses. They roll it back 10-for-1 to wipe out all those individual retail investors who came in, and start the process over again. And if you see a pattern like that, stay away from those groups. The serious companies, they actually treat their shareholders as allies, not as prey to be victimized. And when you have a large, let's say 100, 200 million shares out, you may have a cheap 10 cent stock. By continuing to work and advance the story, if you get a $500 million prize out of it, you have a $2-3 stock. And if you reward those shareholders with from 5 cents all the way up there, then you as a group, you become one of those famous jockeys that everybody else wants to back on their next horse. So too many serial rollbackers, stay away from them. They're not really your friend.
Is it also a red flag if junior mining companies fail to repeatedly return or answer calls?
Well, this goes back to the earlier question. The company has limited resources to deal with, answer all the calls that come in, and obviously they're going to want to call back somebody like me, Kaiser Research, a branded name, a person who, if he writes something, could actually create buying in the stock, and of course, if he writes something negative, it could result in the opposite. Even they will sometimes take time to get back to me because they may be on the project, checking out to make sure that the crew is executing the program as expected, or maybe they're overseas trying to negotiate financing. So I would be cautious about not getting a call back. When you do get a call back, then just listen to how they are treating you. If it's respectful and they're ready to do it, it was not a problem that they didn't call you back right away.
Whether junior mining stock prices increase on promotion and or fundamentals, is there potential money to be made by speculators?
Okay, I apologize in advance for being flip, but the only way to make money is to sell. Yeah, it doesn't matter what makes it go up. You make money by selling. And insofar as where you park your money, if you're parking your money in a junior where it's just going to be a pump and dump, well, if you're in early, you're actually part of the collaboration, the conspiracy to hang others. I prefer to put my money in early with groups where they are actually trying to demonstrate something, and you do want the company to do promotion, because if I'm putting up money early on when it's just a drill target, and then they pull this nice hole, Well, the market doesn't necessarily quadruple the price of the stock just because you have a very encouraging hold. The market needs to hear about it from the company through some sort of promotion. So it's the combination of a sincere effort to create new wealth through a discovery combined with promotion. That's what you want to see. And just betting on companies who, any corporate executive who says promotion is bad, stay away, because that person, even if he or she comes up with a discovery, will end up diluting the hell out of the early backers because the stock just sits there. And the street, the power players and all that, they know how to not exactly help you out with a market cap so that they can finance you at a big premium to what everybody else during the earlier stage paid for the stock.
Generally, how long do you tend to hold on to any specific mining stock?
Well, I tend to be an optimist, even though people think I'm a pessimist, and I often hold companies for a very long period, but I do it with expectations as to what is the company trying to do, and if there are hurdles that come along. For example, one that I've been into for last sort of 7-8 years ended up encountering a mining lease problem earlier this year that turned it into a instant 50% loss, and we had to wait almost 7 months for this thing to be resolved, and now the stock is struggling back up, and so the timeline for my expectation of what is supposed to come out of this story, it has been extended. You hold the stock as long as it is still moving towards the expectations that you have for it, and you need to continually renew what you expect from it. Has anything changed? Has the expectation become smaller? And then you have to make a decision. And then I do like to be always wrong by selling some too soon and some too late. And I've absolutely given up trying to pick the perfect top and come across like a big genius. And so when you're always wrong because you sold some too soon and some too late, you tend to feel like a dummy and grumble a lot when in April you're having to write big checks to Uncle Sam or the Canadian equivalent to pay the capital gains that you racked up by being such a dummy.
John, how can people find out more about Kaiser Research?
Just go to kaiserresearch.com. There's a page there of free stuff where you can examine a lot of the stuff I have available for free. Check it out, get a sense for it. I have a page called Discovery Watch. You can go there and you can listen to our past Discovery Watch episode. It's all organized in alphabetical order of the companies. You can get a sense for how I think about companies and the sorts of stories that I'm interested in. And we do not have a trial or anything like that, but we do have a $200 deal which gives you 3 months, 90 days access to everything. But you're almost better off just paying the $450 for a full year's access to the whole works.
John, thank you so much for being on This Week in Money.
It was a pleasure, Jim.
My guest has been John Kaiser, his website, kaiserresearch.com. Coming up, Ed Steer, next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Ed Steer, founder of EdSteerGoldandSilver.com. He's also a director of GATA, the Gold Antitrust Action Committee. He's speaking to us from Merritt, British Columbia. Welcome back to the show, Ed.
Thanks for having me on, Jim, and good day to all your listeners.
Ed, are gold and silver looking bullish going forward?
Well, for the last month or so, certain things have certainly picked up with gold now north of 14 and silver now trying to creep up on $17. There's no question there's been a sea change in the marketplace. Investor sentiment has changed. The stocks are doing well. Of course, the big concern always is, and always has been, is the positioning of the commercial traders like the U.S. bullion banks in the COMEX futures market, and despite the fact that prices are doing well, the bullion banks are going short these rallies all the way up, and it remains to be seen whether we get the same wash, rinse, repeat cycle that we've always had regarding the price, or whether they're going to finally give up and let the prices do what they want to do. So, no, things are looking pretty good right now, and it's certainly reflected in the share prices.
Is there a worldwide shortage of gold or silver because we don't have a lot of new mines coming online?
Well, if I had to say, is there a shortage? There's lots of gold out there, but most people are hanging on to it with both hands, both arms, and both feet, because, like you said, the mine production isn't what it used to be, and physical demand certainly is taking up everything that's being mined every year, plus a bit more. The central banks of the world, as you know, are buying gold hand over fist. There's not so much a silver shortage out there, but it's the same thing. Industrial demand is very heavy, and the exchange traded funds, I think it was in my column this morning, in the last 4 weeks, 57 or 58 million ounces of physical silver has been deposited in these various silver ETFs worldwide. And I would say, yes, there's a growing physical shortage that will sooner or later manifest itself in the price.
Is that because silver is used for solar panel, and places like California, during certain times of the day, up to 50% of their power is generated by the sun?
Well, certainly solar power, solar arrays certainly account for a decent-sized chunk of the silver demand out there, and it's growing every year. And whether it be investment demand or industrial demand, it doesn't stop. It's the same, and it's growing 1 or 2 or 3% a year. And the mining of silver, the amount of silver coming out of the ground, has actually been decreasing over the last 2 or 3 years. So sooner or later, the supply curve will cross the demand curve, and then I don't care what the boys are doing in the COMEX futures market, there's going to be a race for the physical metal.
It's one of the differences with gold, even though it is used in some industrial uses like computers because it's a superconductor of electricity. Well, so is silver, and silver tends to be consumed as it's used, whereas gold is stored and not consumed.
No, absolutely. There's no question about it. Like, you hit it on the nail on the head there. There is some industrial demand for gold, but primarily it's a reserve asset for the banking system and for investment purposes, and that's where most of the gold end up, is in somebody's vault someplace. Whereas silver, it has a dual purpose. It's an industrial metal, plus it's an investment commodity or investment device, and that dual demand is one of these days going to outstrip supply. And like I said, we're going to see prices a lot higher than they are today.
I saw a documentary on gold, and I don't know if it's still true, where in New York you have the Reserve Bank on one side of the street and one of the major U.S. banks on the other, and down on their vaults, whenever somebody said, "Can I see my gold?" they would roll over a little cart from the reserve over to the bank, and they would say, "That's your gold." Then they would just put it back. But the thing is, they were rolling out the same little cart of gold for everybody who asked to look at their gold. Is that still going on?
I'll tell you what, I haven't heard of that before, and that sounds like it's somewhere in the conspiratorial class, so I'm going to pass on that one because I really don't know.
I guess unless you looked at the serial numbers and recorded them and knew what other people were looking at, you'd never know.
Well, if you have gold held in New York on an allocated basis, you have to have the bar numbers and all the stuff that goes with it. So if it's allocated, I suspect that you own it. But as the Germans found out when they tried to repatriate the gold several years ago, what they got back wasn't what they sent there in the first place. So there are question marks over ownership and how much there is actually there.
Didn't the Germans end up with a bunch of tungsten bars coated with gold?
No, that's in the conspiracy theory category as well. If that had actually happened, I can guarantee you that it would have been worldwide news immediately. And I think that I think somebody was making up tales out of school on that one.
Ed, what are the latest commitment of traders' numbers for gold and silver?
Well, we get the new report this afternoon. It's Friday morning when we're doing this interview, and we get the new one in about 2 or 3 hours. I was talking to Ted Butler on the phone yesterday, and he's expecting a small increase in the commercial net short position in gold. But after the big run-up in silver we've had over the last 5 days or so during that reporting week, there's going to be a fairly serious deterioration in silver. And as I said at the beginning, the banks are going short these rallies all the way up, and it's going to be, it's showing up in the commitment of traders report in gold, and it will certainly show up when it comes out later this afternoon. So they haven't given up the fight for higher prices as of the moment.
What's happening in physical versus paper gold and silver?
Well, we discussed that before, and there's only a limited amount of physical out there, but for the time being, the paper market controls the physical market, and that's not the way it's supposed to be. It's supposed to be supply and demand. And right now, the paper market is wagging it's a paper dog wagging the physical market out there, because they control the price, which is not what it's supposed to be, but that's what it is and what it has been for the last 30 or 40 years.
What would happen if you held a gold or silver certificate and if everybody marched down to their broker and said, I want the physical product delivered in my hands right now?
Well, a paper is paper, and I'm sure if you read the fine print from the brokerage or on the certificate itself, it would allow the brokerage to redeem it for its face value in paper money versus gold. But if everybody went down there at once and said, I want my physical gold, the fact of the matter is it just isn't available. It's like if everybody ran down to their bank today and demanded every cent they had in the bank and in all the banks in Canada, the banking system would be out of business. They just don't have that kind of paper money laying around, and it's the same in the physical market as well.
Can gold and silver move higher while the U.S. dollar continues to be stuck in a narrow trading range?
Oh, absolutely, and it really doesn't matter, and you can see it in the markets even now that it doesn't matter. There are days when the dollar is rising and precious metals are rising too. What the dollar index is or isn't doing isn't really important, but I can pretty much guarantee you that if Donald Trump gets his way and we see, interest rates go down in the United States, then we're going to see a corresponding rise, a fall in the U.S. dollar and a corresponding rise in the price of gold and silver and all hard assets. So that's pretty much baked in the cake over the longer term that once the U.S. dollar starts to decline, we're going to see gold and silver prices rise accordingly. But it isn't that way all the time, and it doesn't have to be that way.
Do you see the U.S. dollar rising or falling?
Well, I expect Mr. Trump wants it to fall. The markets right now have got it up fairly high. And we'll see what happens once we have the FOMC meeting next week. Mr. Powell's going to decide whether we're going to see a 25 basis point rate drop or maybe 50 basis point rate drop. Right now the markets are betting it's going to be 25, and I noticed that Draghi, I think it was yesterday, from the European Central Bank didn't reduce the rates at all. So we'll see what Mr. Powell does on Wednesday.
How are the HUI and XAU indexes looking?
Well, they're looking very positive. The share prices have been going up steadily here for the last 6 weeks or so. And I think, if my memory serves me correctly, the Huey's up almost 30% on the year. And that's a pretty good increase, and it's certainly outperformed just about every other index out there, whether it be the Dow or the S&P. So the gold shares and the silver shares are reflecting the fact that at some point precious metal prices are going much higher.
We'll have more with Ed Steer when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Ed Steer. Ed, are junior gold and silver stocks showing any strength?
Yeah, well, even more so than the stocks in the Hoye and the XAU, the junior producers out there, of which my portfolio was full of them, are outperforming everything else. You take a look at the small producers like Endeavor and Alexco and Great Panther. These are the ones that really take off because they're leveraged to the price of silver to no end. And that same applies to the junior gold producers as well. They're all outperforming their larger peers, and this will continue. And this is one of the principal reasons why the only stocks that I hold are the junior producers, because they tend to outperform the market when it's rising. And on the other side of that coin, of course, when the market is going down, they have a tendency to outperform on the downside as well. So it's a double-edged sword with those kind of companies.
What indicators do you watch for gold and silver?
Basically, I watch the price. Price on one hand, and the other thing, of course, I watch, which we've already spoken about, is what's going on in the Commitment of Traders report. What are the bullion banks and principally J.P. Morgan up to? I know that silver analyst Ted Butler follows what J.P. Morgan does closely, because basically what they do is they are entirely in control of what goes on regarding the price of both precious metals. And so I watch the price on one side and the Commitment of Traders report on the other side to give out some indication of where prices may be headed in the future.
Now, if one bank is monopolizing a particular commodity, should that not be investigated?
Well, this has been going on for a couple of generations now, and of course the CFTC is there supposedly to watch over this to make sure that these things don't happen, and that the banks or any entity don't get too far on the long side or on the short side. But despite the fact that they're supposed to be looking out for this sort of thing, they allow this thing to they've allowed the situation to get completely out of control, where just a small handful of traders in both gold and silver and other commodities like copper and West Texas Intermediate crude, basically a small handful of traders who are neither users nor consumers, and they're all speculators, are setting the prices for all these physical commodities, including gold and silver. And if the CFTC was doing its job, that wouldn't happen. But they're blindly looking the other way, and they're allowing the speculators to control the prices of these key commodities.
Is that because it's people from the big banks, former employees, who end up in positions of high power in government?
Well, that's certainly part of it, but it's also, in my opinion, the banks' attempts to prevent people from running from the paper asset side of the street, like selling their Google shares or their Alphabet or Tesla or whatever, running from the paper asset side of the street to the hard asset side of the street. This struggle between physical commodities and paper assets has been going on for generations now. And as time goes on, it's becoming even more and more intense, and we're starting to see signs now in the last 6 months that at some point the paper asset market is going to crash and burn, and all things physical will take off for the moon and stars, led by, of course, silver and gold.
What's the latest from the Gold Antitrust Action Committee?
Well, I know that, Bill and Chris and myself are out there beating the drum for the cause just about every day. You go to the GATA.org website and you'll see that there are dispatches up there every day about what's happening in the gold world, and Bill and Chris and I are giving interviews like the one I'm giving today. And we go around and speak at various conferences. So as Winston Churchill said, we just keep buggering on until this price management scheme in the precious metals finally comes to the end it so richly deserves.
Ed, how can people find out more about Ed Steer Gold and Silver?
Well, they can just Google my name, Ed Steer, S-T-E-E-R, Ed Steer Gold and Silver Digest, or just my name will do. It'll pop up, and you can go to my sample column page, which is free to read. And if you like what you see, well, you can sign up. And the freight is $100 per year for 260 plus columns per year. So it's only 30 or 40 cents a day. So I consider it to be somewhat of a bargain.
Ed, thanks a lot for being on This Week in Money.
And thanks for having me, Jim.
My guest has been Ed Steer, founder of EdSteerGoldandSilver.com. He's also director of GATA. He was speaking to us from beautiful Merritt, British Columbia. And that wraps up our show for this week. We'd like to thank our guests, Bob Hoye, John Kaiser, and Ed Steer. And thank you for listening. If you have any questions for our guests or the show, you can send them to info@howstreet.com. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Well, Jim, it's always great to be on the show.
Larry, was it a week of a lot of positive news for American Manganese?
Well, we did have a very positive press release on Wednesday, but we had a very active week since last Friday. Actually, it started, we had just close to 1 million share day that day. But so far this week, we've traded over 12 million shares, and we hit a high of 30.5. We're currently trading at 27, and we had a bit of a pullback to 23.5, 23, 24, and which is always healthy on a run up because we started at 15. And as all I can say is that the stock is reacting very well. And people always wonder what's the catalyst for that. Well, certainly we had good results, but that's not the first time. We've had good results for 2.5 years. And you just weren't getting any positive reactions from it. This result, we had a very positive reaction. We had a lot of things that were happening in the background. But the stock, like I say, traded over 12 million shares so far. And it probably will trade about 12.5 million today. At the end of this day, it'll be 12.5 million anyway. But the real catalyst for this whole thing is that there's a different perspective out there, and that perspective has to do with recycling lithium-ion batteries in its entirety. Before it was it can't be done, there's no money in it, and the stories went on and on and on out there, and but now the stories are there is money in it. It can be done, and and we're getting a lot of the headlines on that sort of stuff. So this is what we needed. This is what we needed in the market. When you stop and think about what's happening in the battery industry, there's hundreds of billions of dollars being spent on battery manufacturing. In regards to recycling, you'd be lucky if you hit 100 million. And so that's how puny that investment is at this time, and that's only going to get greater and greater and greater. So as we move through the chute, the holders of American Manganese should see some steady appreciations over the next several months. And, we're getting closer to the end game. We're going to be testing the material from the DOE labs, critical materials, and but we can't do that until we complete stage 5, and so that's the next big thing. All the fabrications and parts are in to do that. So I don't expect that to start till maybe next week sometime. But we're moving ahead. We took the lull in the market to our advantage because we were very quick to move on patents and and all the resulting work that had to be done that makes a patent feasible and allows you to actually obtain that patent. It has to work scientifically, and we have to do the work to back that work up when we file for the patent. So we've got 2 patents, and we'll have a 3rd patent. And all we can do is look forward to better days ahead. I mean, everything we've done so far has been positive, but now we're starting to get recognition. And things in the background that happened, we had that newsletter that went out 6 weeks ago. It hit 82,000 openings last week. I can tell you that there's results directly from that because my LinkedIn is growing at 200 to 300 a week. And, so those are things that bring new eyeballs and potentially new buyers into the market. So, and we've even had the movie star on the project last week, and he was very excited about it. So, I don't know what's happening there. He's certainly, I don't know if he's even taken a position for himself, but regardless, we're getting a lot of fanfare out there. Now, I did have a question that was put in by the CEO Bullboards, and that was to explain our cycles that we go through, like the cathode scrap. And I can tell you that from start to finish, it's about an 8-hour process. And but if you're doing it on a continuous basis, it just that the material you put in at the beginning of the process starts to come out in about 8 hours. But if you're feeding the material in on a continuous basis, that's how we have a continuous result at the back end of the plant. So the prep time is 8 hours, charging the system and everything else that you're doing. And then once you start, if you're in a commercial plant, you start to process the powders at the end of the circuit. You're starting with the stuff that was put in 8 hours ago. But that's now becomes continuous because you keep charging that, then pretty soon you're through the 8 hours, and now you're processing other material. But it's just a continuous basis that keeps that ticking along. And the other question was that the Department of Energy would be building some batteries. I imagine they would build prototypes, and they'll run several cycle tests on it. It's not to see if the material holds up. It's that the process holds up. And because we produce a battery-ready material, and that material is not degraded. I mean, it's base metals. There's no loss or fatigue of that particular product. And, that if it's battery ready and it doesn't need chemical treatment like anybody that's selling material from a storage area, it's been chemically treated, and they may pre-mix it, or they may send it out individually, and then the battery manufacturers mix the material, and they go through gluing it onto a aluminum foil, and then they heat treat that, and that's a product that they make batteries out of. So really what we're not building batteries, we're producing cathode material to sell back to the battery manufacturer. And that's the key to that whole thing. It's it was an interesting question that was posed, and I hope that people realize that it's no different than say a copper operation or a gold operation, where you you've got to run the product, and the product that you're getting out the end didn't come in at the same time. It has to go through a circuit system, and it probably takes a charging time of several hours before it really starts to produce at the end of it in any consistent manner. So it's no different for us. We're only treating base metals or, cathode metals, and the end result is that we have a high-grade product that will be used out in the industry, and they won't have to, dig it out of the ground. They can go right to work on the powder that we produce. So we've had an exciting time. Certainly a good way to end the week. We're basically sitting around 600,000 shares today, which is considerably down from the amounts that we were doing earlier. But I'm really encouraged with the market, and I'm really encouraged with what I'm seeing out there and the response we're getting from, we have to have, I think I've mentioned this so many times and getting blue in the face, but we have a lot of conference calls. And some go nowhere, some go further, and eventually we could end up in an NDA and then have people testing our material. So we're looking forward to a good close on the summer, and I'm hoping that we'll have a partner before the end of the year.
Larry, for people who are new to American Manganese, what's the company all about?
American Manganese is a critical metals company that started its career in the criticality of metals by developing a process for very low grades of manganese in Arizona. And we were successful and actually filed patents on that, and we looked at the patents, and Chemetco recognized that the patented process that we use should work on the cathode materials in a lithium-ion battery. Since then, we've done from proof of concept right up to the pilot plant and filing of patents and actually the receiving of patents, and in a very fast time, I might say, for any new listeners. But that's because we had no conflicting technologies out there, so that's really excellent for protecting our patent. And everything can be found on our website at AmericanManganeseInc.com. You can phone me off 778-574-4444, or you can email me at LREAUGH@AMYMN.com. Or you can go to the website, AmericanManganeseInc.com.
Larry, thank you for the update.
You're welcome.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on July 26th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.